Chapter 4. How to find stocks for trades. Your next challenge as a new trader is how to find actual trades. You may understand how day trading works, but when it comes to actually finding setups in real time, it can be difficult. I certainly experienced this as a new trader. I was often able to see setups in hindsight when I looked back on charts during the day, but finding them while the day was unfolding was very difficult. Alpha predators. You must remember that retail trading does not work on all stocks. It only works on the stocks that have high relative volume. Some stocks like Apple Inc. ticker AAPL will on average trade millions and millions of shares each day, while other stocks on average might trade only 500,000 shares a day. Does this mean you should trade AAPL only? No, high volume will correlate from one stock to another. You don't just look for high total volume. There are some stocks that on average will trade with much volume. You need to look for what's above average for that specific stock. 30 million shares of AAPL traded in one day might very well not be higher than usual. Do not trade AAPL unless it has a very unusual trading volume. If trading volume is not higher than normal, it means that the trading is being dominated by institutional traders and high-frequency trading computers. Stay away from it. AAPL Daily Chart for Summer 2016. Days that AAPL had a significant relative volume are marked. Those days were suitable for day trading AAPL. Take a look at the AAPL Daily Chart for the summer of 2016. As you can see, there were only 2 days that had high relative activity. They're marked with arrows on the chart. Interestingly enough, when you take a close look at the chart, you realize that on those days the stock gapped up or down. I marked those price gaps in the chart. If you wanted to trade AAPL, you should have traded it only on those days. The other days were comprised of just normal, high-frequency, algorithmic trading. Retail traders should stay away from stocks that are trading normally. The most important characteristics of high relative volume stocks is that these stocks trade independent of what their sector and overall market are doing. When the market is weak, it means that the majority of stocks are selling off. It does not matter if it is Apple, Facebook, Amazon or Exxon. When the market is strong, the prices of the majority of stocks will be going higher. Similarly, when you hear someone say the market is bear or collapsing, they don't mean a specific stock. They mean that the whole stock market is losing its value, all stocks together. The same is true for specific sectors. For example, when the pharmaceutical sector is weak, it means all of the pharmaceutical companies are losing their values together. How do you recognize behavior of market? Index funds such as the Dow Jones Industrial Average (DJIA) or the S&P 500 SPY are usually good indicators of what the overall market is doing. If Dow Jones or the SPY are red, it means that the overall market is weak. If the Dow Jones or SPY are strong, then the overall market will be going higher. The behavior of stocks that have high relative volume is independent of the overall market. Every day, only a handful of stocks are being traded independently of their sector and the overall market. Day traders trade only those stocks. I call those stocks alpha predators. In the animal kingdom, an alpha predator is a predator at the top of a food chain upon which no other creatures prey. In day trading, alpha predator stocks are the ones that are independent of both overall market and their sector. The market cannot control them. Therefore, the next rule is about alpha predators. Rule 7. Retail traders trade only alpha predators, high relative volume stocks that have fundamental catalysts and are being traded regardless of the overall market. What makes a stock an alpha predator? Usually it is the release of fundamental news about the stock either the day before or during the same trading day. Important news or events for companies can have huge effects on their value in the market and therefore act as fundamental catalysts for their price action. As mentioned in Chapter 2, some examples of the fundamental catalysts for stocks that make them suitable for day trading include earnings reports, earnings warnings, pre-announcements, earnings surprises, FDA approval, disapproval, mergers, acquisitions, alliances, partnerships, major product releases, major contract wins, losses, restructuring, layoffs, management changes, stock splits, buybacks, debt offerings. Higher. Similarly, when you hear someone say the market is bear or collapsing, they don't mean a specific stock. They mean that the whole stock market is losing its value, all stocks together. The same is true for specific sectors. For example, when the pharmaceutical sector is weak, it means all of the pharmaceutical companies are losing their values together. How do you recognize behavior of market? Index funds such as the Dow Jones Industrial Average (DJIA) or the S&P 500 SPY are usually good indicators of what the overall market is doing. If Dow Jones or the SPY are red, it means that the overall market is weak. If the Dow Jones or SPY are strong, then the overall market will be going higher. The behavior of stocks that have high relative volume is independent of the overall market. Every day, only a handful of stocks are being traded independently of their sector and the overall market. Day traders trade only those stocks. I call those stocks alpha predators. In the animal kingdom, an alpha predator is a predator at the top of a food chain upon which no other creatures prey. In day trading, alpha predator stocks are the ones that are independent of both overall market and their sector. The market cannot control them. Therefore, the next rule is about alpha predators. Rule 7. Retail traders trade only alpha predators, high relative volume stocks that have fundamental catalysts and are being traded regardless of the overall market. What makes a stock an alpha predator? Usually it is the release of fundamental news about the stock either the day before or during the same trading day. Important news or events for companies can have huge effects on their value in the market and therefore act as fundamental catalysts for their price action. As mentioned in Chapter 2, some examples of the fundamental catalysts for stocks that make them suitable for day trading include earnings reports, earnings warnings, pre-announcements, earnings surprises, FDA approval, disapproval, mergers, acquisitions, alliances, partnerships, major product releases, major contract wins, losses, restructuring, layoffs, management changes, stock splits, buybacks, debt offerings. You definitely can become a full-time profitable day trader without short-selling risky stocks, so leave that to the Wall Street professionals. The second category is medium float stocks in the range of $10–100. These stocks have medium floats of around 5 million to 500 million shares. Most of my strategies explained in this book work well on these stocks, especially the VWAP and support or resistance strategies. Medium float stocks that are more expensive than $100 are not popular among retail day traders and I myself avoid them. You usually cannot buy many shares of them because of their high price. Therefore, it is basically useless to day trade them. Leave them for the institutional traders. The third category of stocks for trading is mega cap stocks like Apple, Alibaba, Yahoo, Microsoft and Home Depot. These are well-established companies that usually have over $500 million in shares outstanding available for trading. These stocks are traded in millions of shares every day. As you may guess, these stocks move only when large institutional traders, investment banks, and hedge funds are buying or selling large positions. Retail traders like us, who typically trade 100 to 1,000 shares, usually cannot move the price of these stocks. Retail traders should avoid these stocks unless there is a good fundamental catalyst for them. From the strategies set forth in Chapter 7, reversals and moving average strategies usually work well on these stocks. Do not forget though, unless there is a fundamental catalyst, these stocks are being heavily traded by computers and high-frequency traders and are not suitable for retail day trading. The table below summarizes these categories. Float price Rangami favorite strategy Chapter 7 low float less than 5 million under $10 only momentum long medium float 5 to 500 million $10 $100 all mostly VWAP and support or resistance large floats plus 500 million any usually plus $20 all mostly moving average and reversal finding trades. Trades can be found in two ways. Pre-market morning watch list real-time intraday scans. Let me explain how each day I find alpha predators for trading. I use my scanner every morning and program it to find stocks suitable for my day trading based in the following criteria. Stocks that in the pre-market gapped up or down at least $1, stocks that have traded at least 50,000 shares in the pre-market, stocks that have an average daily volume of over 1 million shares, stocks that have average true range of over 50 cents. There is a fundamental catalyst for the stock. Why these criteria? When there are some fundamental catalysts, there will be unusual pre-market activity. Stocks gap up or down before the market opens with a significant number of shares being traded, such as 50,000 shares. I look for highly traded stocks, so that buying and selling 1,000 shares won't be a problem. That is why I am looking at stocks with an average daily volume of over 1 million shares. I also am looking for stocks that usually move in a good range for trading. That is why I look at average true range ATR. ATR means how large of a range a stock has on average every day. If ATR is $1, then you can expect the stock to move around $1 daily. That is a good number. If you have 1,000 shares, you may profit $1,000 from the trade. But if ATR is only 10 cents, then the trading range is not attractive for me. Let's look at an example of how my watch list will form. On August 19, 2016 at 9 a.m. Eastern Time, my scanner showed these stocks. My Gappers watch list on August 19, 2016 at 9 a.m. Est. As you can see, I have highlighted the gap percent and float columns on my watch list. From over 4,000 stocks, I now have only 9 candidates. I will go over each of them before the market opens at 9:30 a.m. I will check the news on each of them to learn why they gapped up or down. Is there a fundamental catalyst for that stock? Has there been any news coverage or extreme events for the company? From these 9, I usually select 3 or 4 stocks to watch closely. You cannot watch Nina stocks, and regardless, there are usually no more than 2 or 3 good candidates. I watch them closely on my screen, looking for potential setups. I plan my trades before the market opens and then wait for the market bell. I then trade my plan. Real-time bull flag momentum scanner. For the momentum strategy, as I explained above, you need to find low float stocks that are moving. You cannot find these stocks unless you are using a good scanner. I am using the Trade Ideas scanner. www.trade-ideas.com. My intraday real-time bull flag momentum scanner. In the screenshot above, you can see how I am scanning real-time for my momentum strategy. During the day, the scanner is finding stocks that have high relative volume, low float, and high activity. I then check them in my trading platform and decide, based on my momentum strategy set out in Chapter 7, if I want to trade them. Real-time reversal scanner. Stop and bottom reversal strategy is another type of strategy that you cannot find stocks for in the pre-market. You must have an intraday real-time scanner. Here is an image of a top and bottom reversal scan. My intraday real-time reversal scanner. As you can see, I am scanning the market real-time to find stocks that are selling off or surging up so I can trade my reversal strategies. You can read more about these strategies in Chapter 7. I won't go into the details here about how to make these scans, but I will explain in Chapter 7 under each strategy the specifics of what to look for in stocks in each category. If you develop new strategies for yourself, you can define new scanners for yourself. These scanners are highly adjustable and you can change the parameters as you like. These are the parameters that work for me, but as you gain experience and learn more about other strategies and your trading style, you may very well decide to define new scanners for yourself. Many new traders don't initially need a scanner. If you join a community of day traders such as www.vancouver-traders.com, you will be able to see my scanner in real time. These scanners are costly, around $100 per month, so at the beginning of your career transition to day trading, you will probably want to keep your expenses down as much as possible. Planning the trade based on scanner. Since I find my daily alpha predators, the stocks that are independent of the overall market, I start to look for the individual setups in them. I constantly monitor their charts and try to plan a trade based on the strategies detailed in Chapter 7. I usually select 3 alpha predators and watch them separately on my 3 monitors. When I see a potential strategy, I plan my trade. This is a fast decision-making process. Sometimes you have to plan a trade in a few minutes and at other times in just a few seconds. This is why you need months of training in simulator accounts to well understand the decision-making process. I focus considerably on quality versus quantity. There are millions of traders out there, in theory, or no doubt millions of strategies out there as well. I had to find the strategy that worked best for me, my personality and my account size. I've found a strategy that works really well for my students as well as for my own personal trading. This strategy involves taking only the best setups and waiting on the sidelines until I see something worth trading. Day trading can be a boring profession. Most of the time you are just sitting and watching your list. In fact, if day trading is not boring for you, then you are probably overtrading. If you require a reminder of the importance of patience in trading, here it is. There are plenty of traders out there who are making the error of overtrading. Overtrading can mean trading 20, 30, 40, or even 60 times a day. If you do that, your broker will love you. You'll be commissioning them to do all of those trades, so you are going to lose both money and commissions. Many brokers charge $4.95 for each trade, so for 40 trades, you will end up paying $200 per day to your broker. That is a lot. Remember, your goal is to trade well, not to trade often. Another problem with overtrading is risk. While you're in a trade, you're exposed to risk, and that's a place you don't want to be unless you have proven that there is a setup in the strategy worth trading. Here is my next golden rule. Rule 8. Experienced traders are like guerrilla soldiers. They jump out at just the right time, take their profit, and get out. The stock market is controlled by machines and highly sophisticated algorithms, and, as a result, there is considerable high-frequency trading. High-frequency trading creates significant noise in the price action and is specifically designed to shake out retail traders like you and me. You moose. Be smart. Don't expose yourself to them. Profitable traders usually make only 2 or 3 trades each day. They then cash out and enjoy the rest of their day. Chapter 5. My tools and platforms. Like starting any other business and profession, to start day trading you require a few important tools. You need a broker and an order execution platform. These are tools you will definitely need for yourself. As explained in Chapter 4, you will also need a stock scanner to find your watch list and look for potential real-time setups. You may not need a scanner though if you are part of a trading community. People who are part of our community in www.vancouver-traders.com can see my screen in real time and use my scanners. What broker to use? For day trading, you need an awesome broker. You don't need a good broker, you need an awesome broker. Your broker is your vehicle to trade. If you have a bad broker, you lose money, even if you are trading properly and accurately, because a broker eventually has to fill your order in time and at a good price. There are many brokers out there with various software and price structures. Many of them are great but expensive, some are terrible but cheap, and many of them are either terrible or expensive or both. For the sake of keeping this book short, I will not start reviewing all of them, but I do have additional information on my website about brokers and which ones to choose. If you visit my website, you will have access to that information. I will share here though what broker I am using and why. For several good reasons, I am currently using Interactive Brokers or IB www.interactivebrokers.com. First, I live in Vancouver, Canada, and IB allows me to have my tax-free and registered retirement accounts for day trading. Many brokers do not allow you to have tax-free or retirement accounts for day trading. Second, IB is an inexpensive broker. It charges you less than $1 per trade. Another reason I am with IB is because IB does not require people in Canada to have a minimum of $25,000 for day trading. If you are in the USA, you will probably need a minimum of $25,000 for day trading. You can read further about the pattern day trade regulation online. Do remember that brokers will give you 3 to 6 times leverage. If you put in $30,000, you're going to have $120,000 in buying power, a leverage of 4:1 in this case. That leverage is called the margin, and you're allowed to trade on margin, but you need to be responsible about it. It is easy to buy on margin, but it is also very easy to lose on margin. If you lose on margin, your broker takes the loss from your main money account. Therefore, margin is a double-edged sword. It provides you an opportunity to buy more, but it also exposes you to more risk. There is nothing wrong with buying in margin, but you do have to be responsible. Margin is like a mortgage for your house. You borrow a significant amount of money and buy airsidence. Banks will give you a mortgage, but they won't take any responsibility or risk on it. For example, imagine that you put $100,000 down and borrowed $900,000 on a mortgage 10:1 leveraged from your bank to buy a $1 million house. If the price of your house goes up to $1,200,000, you still owe the bank the original $900,000 plus their interest. So the extra $200,000 is your own profit that actually came from margin leverage. You couldn't have bought that house without mortgage leveraging. Now imagine that the price of the house drops to $900,000. You still owe the bank $900,000 plus their interest, so the drop has hit your main $100,000 and you have lost all of your original down payment of $100,000. That is the other side of leveraging. Therefore, you need to be responsible about when and how much you use your account margin. When a broker sees that you are using leverage and losing money, they might issue a margin call to you. A margin call is a serious warning and day traders must avoid getting them. It means that your loss is now equal to the original money you had in your account. You must add more money or else your broker will freeze your account. If you need to know more about margin, leverage or margin calls, check the broker's website, do some research on the internet, or ask me or other traders in our private chat room at www.vancouver-traders.com. Trading platform and market data. Fast trade execution is the key for day trader success. You need to be able to move in and out of trades quickly. If your broker doesn't use a software or platform that has hotkeys, you're not going to get in and out of trades fast enough. I can't tell you how many times I've been up $1,000 because all of a sudden the stock spikes. When stock spikes, you want to be able to put money in your pocket and profit from it quickly. You definitely don't want to be fumbling with your orders. You need quick executions, which is why I highly recommend a good broker and a fast order execution platform. I use DAS Trader www.dastrader.com as my trading platform. DAS systems provide one of the most efficient execution solutions for online brokers, institutional trading desks and traders worldwide that demand smarter execution services. On a literally 24/7 basis, I have found their support team incredibly helpful and competent. DAS servers are co-located with Nasdaq data centers. You cannot be any closer to the market for trading than this. DAS Trader is not a broker, but you can link your trading account to its platform for fast order execution. Some brokers will offer you the DAS platform when you open an account, but IB has its own platform that I do not recommend. I have a subscription to DAS and they have linked my IB account to the DAS platform. Watch List and Scanary talk to new traders almost every single day. I talk to hundreds of traders every month. One of the common themes among new traders is not knowing what to trade. Thousands of stocks are moving in the market every single day, But finding a setup that is both consistent and a good feed is really hard. I use Trade Ideas software www.trade-ideas.com for scanning the market and finding good trades. I explained my scanners and watch list building in Chapter 4, and I will explain in detail later in this book what I am looking for with my scanner as well as my trading strategies. You will also see some pictures of my scanner in the sections that follow. If you join our free private chat room, you will see my scanner online in real time and will be able to observe how I use it. Community of traders trading alone is very difficult and can be emotionally overwhelming. It is beneficial to join a community of traders and ask them questions, talk to them if needed, learn new methods and strategies, get some hints and alerts about the stock market, and also make your own contributions. I personally trade in a private chat room with some of my friends and family. We can talk to each other and everyone can view my live screen and platform and watch how I am trading. It is a fun, interactive environment, and we all learn from each other. I frequently answer questions from other traders, and if there is anything I'm not sure of, I will ask other traders. There are some experienced traders in our chat room that I learn much from, and we tip each other off about potential good trades and setups. We would like to grow our chat rooms slightly, and therefore everyone who is reading this book is welcome to join with us. It is free, of course, and you will benefit from both watching me trade and hearing my responses to questions people have, including your own questions. If you join me, you will see that quite often I lose money. It is always a good feeling to see that losing money is not just limited to yourself, but that everyone, including experienced traders, have to take some losses. It is part of the process. There are many chat rooms that you can join on the internet. Some of them are free, but most of them require payment. You can join our chat room, of course, for free, and see my screen in real time while I am trading and explaining me strategy. You can take trades with me, or just watch and listen. You can also take your own trades and still be part of my community. If you are interested in watching me or talking to me, check out our private chat room at www.vancouvertraders.com. It is extremely important to remember, however, that if you are in any community of traders, either our chat room or the dozens of others that are out there, you should not follow the pack. You need to be an independent thinker. Generally, people change when they join crowds. They become more unquestioning and impulsive, nervously searching for a leader whose trades they can mirror. They react with the crowd instead of using their minds. Chatroom members may catch a few trends together, but they get killed when trends reverse. Never forget that successful traders are independent thinkers. Simply use your judgment to decide when to trade and when to not. Chapter 6. Introduction to Candlesticks. To understand my strategies in the next section, we need to quickly review price action and the fundamentals of candlestick charts. The Japanese began using technical analysis and some early versions of candlesticks to trade rice in the 17th century. Much of the credit for candlestick development and charting goes to a legendary rice trader named Homma from the town of Sakata, Japan. While these early versions of technical analysis and candlestick charts were different from today's version, many of the guiding principles are very similar. Candlestick charting, as we know it today, first appeared sometime after 1850. It is likely that Homma's original ideas were modified and refined over many years of trading, eventually resulting in the system of candlestick charting that we now use. In order to create a candlestick chart, you must have a data set that contains 1. Open price, 2. Highest price in the chosen time frame, 3. Lowest price in that period, and 4. Closing price values for each time period you want to display. The time frame can be daily, 1 hour, 5 minute, 1 minute, or any other period you prefer. The hollow white or filled red portion of the candlestick is called the body. The long thin lines above and below the body represent the high-low range and are called shadows, also referred to as wicks and tails. The high is marked by the top of the upper shadow and the low by the bottom of the lower shadow. If the stock closes higher than its opening price, a hollow candlestick is drawn with the bottom of the body representing the opening price and the top of the body representing the closing price. If the stock closes lower than its opening price, a filled, usually red candlestick is drawn with the top of the body representing the opening price and the bottom of the body representing the closing price. Candlestick examples. Compared to other forms of representing price action, many traders consider candlestick charts more visually appealing and easier to interpret. Each candlestick provides an easy-to-decipher picture of price action. A trader can immediately compare the relationship between the open and close as well as the high and low. The relationship between the open and close is considered vital information and forms the essence of candlesticks. Here is my 9th day trading rule. Rule 9. Hollow candlesticks, where the close is greater than the open, indicate buying pressure. Filled candlesticks, where the close is less than the open, indicate selling pressure. Traders can be divided into 3 groups: buyers, sellers, and the undecided. Buyers want to buy as little as possible and sellers want to charge as much as possible. Their permanent conflict is reflected in bid-ask spreads. Ask is what a seller asks for merchandise. Bid is what a buyer offers for that merchandise. Prices are created by masses of traders, buyers, sellers, and undecided people. The patterns of prices and volume reflect the mass psychology of the markets. The goal of a successful day trader is to discover the balance of power between buyers and sellers and bet on the winning group. Fortunately, candlestick charts reflect this fight in action. A successful day trader is a social psychologist armed with a computer and charting software. Day trading is the study of mass psychology. The presence of undecided traders puts pressure on bulls and bears. Buyers and sellers move the prices fast because they know that they're surrounded by a crowd of undecided traders who could step in and snatch away their deal at any moment. Buyers know that if they think too long, another trader can step in and buy ahead of them. Sellers know that if they try to hold out for a higher price, another trader might step in and sell at a lower price. The crowd of undecided traders makes buyers and sellers more willing to deal with their opponents. Buyers are buying because they expect prices to rise. Sellers are selling because they expect prices to fall. Buying by bulls pushes markets up, or as I phrase it, buyers are in control. Selling by bears pushes the markets down, or as I express it, sellers are in control. Undecided traders make everything happen faster by creating a sense of urgency among buyers and sellers. Candlesticks tell us a great deal about the general trend of a stock and the power of buyers or sellers in the market. Candles are always born neutral. After birth, they can grow to become either bearish, bullish or, on rare occasions, neither. When a candle is born, traders do not know what it will become. They may speculate but they do not truly know what a candle is until it closes. After a candle is born, the battle begins. The bulls and the bears fight it out, and the candle displays who is winning. If buyers are in control, you will see the candle move up and form a bullish candle. If sellers are in control of the price, you will see the candle move down and become a bearish candle. You may be thinking that this is all very obvious, but many traders don't see candles as a fight between buyers and sellers. That little candle is an excellent indicator that tells you who is currently winning the battle, the bulls buyers or the bears sellers. Candles with large bodies toward the upside, like the figure below, are very bullish. As you can see, it means that the buyers are in control of the price action, and it is likely that they'll keep pushing the price higher. The candle not only tells you the price, it tells you that the bulls are winning and that they have power. Bullish candles. A series of bullish candles shows bulls buyers are in control of the price. On the other hand, bearish candles are any candles that show a bearish body. So what does the bearish candle tell you? It tells you that the sellers are in control of the price action in the market. It tells you that the sellers are currently in control, so buying or a long position would not be a great idea. Red candles that have this big red body mean the open was at a high and the close was at a low. This is a good indicator of a bearishness in the market. Bearish candles. A series of bearish candles shows bears sellers are in control of the price. Just by learning to read candlesticks, you will begin to generate an opinion on the general attitude for a stock. This is called price action. Understanding who is in control of the price is an extremely important skill in day trading. A major goal of a serious day trader is to discover the balance of power between bulls and bears and to bet on the winning group. If bulls are much stronger, you should buy and hold. If bears are much stronger, you should sell and sell short. If both camps are about equal in strength, wise traders stand aside. They let the bulls and the bears fight with each other and enter trades only when they are reasonably certain which side is likely to win. You never want to be on the wrong side of the trade. It is important therefore to learn how to read candlesticks and how to constantly interpret the price action while you are trading. There are hundreds of imaginatively named chart patterns that you will find with a Google search, including head and shoulders, cup and handle, abandoned baby, dark cloud cover, downside Tsuki gap, dragonfly, morning star, evening star, falling three methods, harami, stick sandwich, three black crows and three white soldiers. Believe me, I did not make any of these names up. These candlesticks are really out there. As intriguing as their names might be, many of them, in my opinion, are useless and confusing. Therefore, I skip discussing most of them in this book. In my opinion, trend lines and most charting patterns are quite subjective and can result from wishful thinking and self-deception. You can draw a trend line across any prices or zones in a way that can change its slope and its message. If you're in a mood to buy, you can draw your trend line a little steeper. If you feel like shorting and squint at a chart, you'll recognize a head and shoulders pattern. None of those patterns are objective, and I am skeptical of claims regarding even classical formations, such as cup and handle and head and shoulders. The biggest pitfall with this kind of pattern charting is wishful thinking. Traders will find themselves identifying bullish or bearish patterns depending on whether they're in a mood to buy or sell. In the next section, I'll give you a quick overview of the two most important patterns for day trading, spinning tops and dojis, and then, in Chapter 7, I will explain how you can trade using these patterns. Spinning tops are candles that have similarly sized high wicks and low wicks that are usually larger than the body and will often be a little bit more indecisive. For the sake of poetry, let's call them candles of indecision. In these candlesticks, the powers of the buyers and the sellers are almost equal. Although no one is in control of the price, the fight continues on. Usually the volume is lower in these candlesticks as traders are waiting to see who wins the fight between the sellers and the buyers. Trends in price can change immediately after indecision candles and therefore are important to recognize in the price action. Buying and selling pressure definition on spinning top candlestick. Formation of spinning top candlestick for reversal trends. Dojis. Simple, shooting star, and hammer dojis are another important candlestick pattern and come in different shapes and forms but are real characterized by having either no body or a very small body. A doji is also an indecision candlestick that is similar to a spinning top. When you see a doji on your chart, it means there is a strong fight occurring between the bears and the bulls. Nobody has won the fight yet. Examples of doji candlesticks. In the picture above, a doji tells us the same story as a spinning top does. In fact, most indecision reversal candles tell you basically the same thing. This will be discussed in greater detail in the next section. At times dojis have unequal top and bottom wicks. If the top wick is longer, it means that the buyers tried unsuccessfully to push the price higher. These types of dojis, such as the shooting star, are still indecision candlesticks, but they may indicate that the buyers are losing power and that the sellers may take over. If the bottom wick is longer, as in hammer dojis, it means that the sellers were unsuccessful in trying to push the price lower. This may indicate an impending takeover of price action by the bulls. Bottom reversal strategy with an indecision hammer candlestick formed as sign of entry. All dojis indicate indecision and possible reversals if they form in a trend. If a doji forms in a bullish trend, it suggests that the bulls have become exhausted and the bears are fighting back to take control of the price. Similarly, if a doji forms in a bearish downward trend, it suggests that bears have become exhausted and the bulls buyers are fighting back to take control of the price. Top reversal strategy with an indecision shooting star candlestick formed as sign of entry. After learning these candlesticks, it is important that you not get too excited too quickly. Candles are not perfect. If you take a trade every time you see a doji formed in a trend, you will end up with significant losses. Always remember that these candles only indicate indecision and not a definite reversal. To use indecision candles effectively, you must look for confirmation candles and ideally use them with other forms of analysis such as support or resistance levels, both of which are explained in Chapter 7.